Unit 2, the name of the topic is Investment Function. Introduction. The volume of employment, that means the level of employment and income, depends on the level of effective demand, which in turn depends on consumption function, that is nothing but propensity to consume, and investment function, that is inducement to invest. Inducement to invest means money which is invested by businesses because of demand which is created in other parts of economy. Further, always remember students, investment function is the second component of effective demand. Thirdly, since consumption function is relatively stable in the short run, so fluctuations in employment and income depends primarily on investment function. Meaning, investment function refers to inducement to invest, also called as investment demand, that is volume of new investment, that is level of new investment undertaken by private entrepreneurs. In simple words, investment means production of new capital goods, that is plant and equipment. The first question in this topic of investment function is types of investment. Let us understand this. Types of investment. The very first type is autonomous investment. Autonomous investment is an investment which does not change with the changes in income. This means that autonomous investment remains constant. So even if income is high or low, the autonomous investment will remain constant. That is why we say that autonomous investment is independent of changes in income. That is, it does not depend on the level of income. For example, look in the figure, students, towards the right. The x-axis denotes income, while the y-axis denotes the level of investment. So initially, the level of income is OY1 and the level of investment is OI. Now, when the income increases from OY1 to OY2, the level of investment still remains the same. Can you see this horizontal line II? It clearly shows that even though the income increases from OY1 to OY2, but the level of investment remains the same, that is OI. This shows autonomous investment. The next type of investment is induced investment. Induced investment is opposite of autonomous investment. So induced investment is an investment which changes along with the change in income. And that is why we say that induced investment is dependent on income. That is, if income is high, investment also increases. For example, look in the figure, students. In the figure, you will see that initially the income level is OY. So when the income level is OY, the level of investment is OI. But when the income level increases from OI to OY1, the level of investment also increases from OI to OI1. So this shows induced investment. The third type of investment is real investment. Keynes has given importance to real investment and not financial investment. Real investment means creation of new capital goods such as machinery. Real investment increases the aggregate demand and thus leading to increase in level of employment generation and national income growth. Investment in capital goods like equipment, construction of roads, railways are all examples of real investment. The fourth type of investment is financial investment. Financial investment means purchase of securities, bonds, and equities. Financial investment does not affect aggregate demand and therefore has no effect on employment generation and national income growth. The fifth type of investment is gross investment. Gross investment, in simple words, refers to total amount invested in purchase of new capital goods. The sixth and the final type of investment is net investment. Net investment is obtained by subtracting depreciation from gross investment. Therefore, as you can see in the formula, net investment is gross investment minus depreciation. As we know, depreciation means some form of spending which is made in order to replace the machinery or capital assets which are out of working condition or have become obsolete, that is very old. Further, if gross investment is greater than depreciation, then there will be net investment and therefore the capital stock will increase. On the other hand, if gross investment is lesser than depreciation, then there is disinvestment and due to this the capital stock decreases. Disinvestment means sale of assets by the government. The next question in this topic of investment function is determinants of investment. Determinants of investment. According to Keynes, the volume of investment, which is denoted by the capital I, is undertaken by private entrepreneurs in the economy, which depends on two factors. One is marginal efficiency of capital, that is MEC. This MEC is denoted by small letter e. And the second factor is the rate of interest, which is denoted by small letter I. Thus the equation is I, that is investment demand, is a function of E, that is MEC, and small letter I, that is rate of interest. The prospective investor. Prospective investor means the expected investor who wants to invest will keep on comparing MEC with rate of interest. They are induced to create new investment, that is they will be motivated to create new investment only if there is a positive difference between MEC and rate of interest. So MEC has to be more than rate of interest. Determinants of investment. As we know, there are two determinants of investment. First is MEC, that is marginal efficiency of capital, and second is rate of interest. Let's understand more about MEC. Now students, production in a capitalist economy is always profit oriented. So since the primary goal of every businessman is profit maximization, therefore they are induced to invest only if they expect to get profits. Therefore, Keynes has introduced this concept of MEC, that is marginal efficiency of capital. So MEC in simple words means expected rate of profit. So MEC is the expected rate of return over the cost of a capital asset. MEC of a capital asset is the highest rate of return over the cost expected from an additional unit of that capital asset. The MEC depends on two factors. First is prospective yields and second is supply price. Prospective yield means expected rate of return of a capital asset over its entire lifetime. And supply price means the replacement cost of the capital asset. Therefore, MEC is nothing but the ratio of these two factors, that is prospective yields and the supply price. Definition of MEC. This definition is given by Keynes. Keynes has defined MEC as the rate of discount which would make the present value, that is the current value, of the prospective yields, that is expected rate of return from a capital asset, equal to its supply price, that is equal to its replacement cost of the capital asset. Therefore, supply price is equal to discounted prospective yields. So we have an equation here. So in the equation, the capital C stands for supply price of the capital asset. The right hand side of the equation, that is R1, R2, R3, this will continue till Rn, that is infinite times. So R1, R2, R3, all this stands for prospective yields, annual prospective yields, while the small letter E stands for MEC. So through this equation, students, we will be able to find the value of MEC. Now let's understand the MEC schedule. The table in the slide shows the MEC schedule. So MEC schedule shows that as the investment level increases in a particular capital asset, the MEC goes on falling. This takes place mainly for two reasons. First is because there is a fall in the prospective yield, because the profits get distributed over large number of investors. And second reason is due to increase in supply price because of pressure on the production facilities. This is the diagram of MEC. In this diagram, the x-axis is denoted by the volume of investment and y-axis is denoted by MEC. The shape of the MEC curve is downward sloping. This shows an inverse relationship between the level of investment and MEC. This means as the level of investment increases, the MEC starts falling or declining. Let's understand this MEC diagram in much more detail. As we saw in the last slide, we have understood that MEC curve shows inverse relationship between investment and MEC. So this means that as level of investment increases, MEC declines. So let's assume that our initial level of investment and MEC is denoted through these green lines, right? So the horizontal green line denotes MEC and vertical green line denotes the level of investment. Now if this green line shifts from green line to blue line, okay, so our initial level of investment is denoted through green and initial level of MEC is denoted through the horizontal green line. So if it shifts from green line to blue line, then it shows that the level of investment, as the level of investment increases, the MEC level falls. This clearly shows the inverse relationship between MEC and investment. I repeat, if the green line shifts to blue line, so we can clearly see that the level of investment has increased while the MEC level has fallen. Similarly, on the other hand, if this green line shifts to the red line, then we can see that the level of investment falls and the level of MEC rises. Again, it shows inverse relationship between investment and MEC. This diagram here shows the shifts in the MEC curve. So as you can see, the initial MEC curve is sloping downwards from left to right. The new MEC curve, so this MEC curve have shifted upwards from MEC to MEC1. So this shift in MEC curve is caused due to changes in profit expectations because of growth and technological progress. The next question in the topic investment function is determination of equilibrium level of investment. We have already studied that the volume of investment is determined by MEC and the rate of interest. As long as MEC is higher than the rate of interest, investment will be continued to be made. So the equilibrium level of investment will be established at a point where MEC becomes equal to the current rate of interest, which is denoted by small I. In case if the rate of interest is lower than MEC, so the market value of expected prospective yields from capital asset will be higher. Keynes has made a clear distinction between the supply price and the demand price of the capital asset. So the supply price of a capital asset is equal to the sum of the expected prospective yields discounted by the MEC, which is denoted by small letter e. On the other hand, the demand price of a capital asset is equal to the sum of the expected prospective yields discounted at the current rate of interest, which is denoted by small letter I. Both supply price and demand price can be expressed from the following equations. When the supply price is less than the demand price, the MEC will be more than the rate of interest, and therefore investment will increase because new investment in capital assets will be profitable. On the other hand, when the supply price is greater than the demand price, MEC will be lower than the rate of interest, and therefore investment level will fall. When the supply price is equal to demand price, MEC will be equal to the rate of interest, and therefore MEC will neither increase nor decrease. So we say that investment will have no change. Thus students, it is always said that investment will be in equilibrium when MEC becomes equal to the given current rate of interest. These are the two diagrams under the topic of determination of equilibrium level of investment. Let's understand each of these diagrams in detail. Let's understand the diagram now. On the x-axis, we plot volume of investment, while on the y-axis, we plot MEC and the rate of interest. Investment, as you know, will always be in equilibrium when MEC is equal to the current rate of interest, that is I. Now between the two, that is between MEC and rate of interest I is said to be relatively sticky in the short run, and therefore investment is largely determined by the MEC. Further, in the diagram, changes in investment are always largely affected or rather influenced due to the shifts in the MEC curve. So look at this diagram towards the left. Initially, the rate of interest is OI1 and the level of investment is OM1. If the rate of interest falls from OI1, to OI2, the level of investment increases from OM1 to OM2. Students, always remember, whenever the profit expectations changes, the MEC curve will shift. So look at the second diagram towards the right. So in this diagram, when profit expectations rise, MEC curve shifts towards the right. So the initial MEC, we have initial MEC curve which shifts to the right to MEC 1. Further, at rate of interest I, the investment rises. So the initial investment was OI1. So it, because there is a shift in the MEC curve from MEC to MEC1, as a result of this, the level of investment also further rises from OI1 to OI2. On the other hand, when profit expectations fall, MEC curve will shift towards the left, and as a result of this, further the investment level will also fall. The last question under this topic of investment function is factors affecting MEC. Let's understand this. Factors affecting MEC. There are many short-run and long-run factors that affect the MEC in an economy. Let's first understand the short-run factors affecting the MEC. The very first one is expectations about demand, price, and cost of production. If the business community expects that the demand for goods to rise and their prices to rise further, which would be more than their cost, then there will be a high MEC. On the other hand, if entrepreneurs expect that the demand of goods to fall and prices to fall lower than the cost of production, then there will be a declining MEC. The second short-run factor is business optimism and pessimism. Business optimism means that businesses or entrepreneurs have a hopeful situation, or they expect full confidence in their businesses or in the economic situation, while business pessimism is opposite of optimism. So business pessimism means that the entrepreneurs or businessmen think that there will be a worse situation or something bad will happen. So thus, business psychology plays a very important role in determining the MEC. So if there is atmosphere of business optimism, that is, if businesses feel full confidence, then entrepreneurs would expect a high MEC. On the other hand, if businesses feel or they have an atmosphere of business pessimism, that is thinking about the worst or something bad will happen, then there will be a low MEC. The third factor of under short run is change in income. For example, in an economy, if the government reduces taxes, this will lead to an increase in the level of income among the people. This would encourage more demand, and as a result of this, the MEC will rise. Further, MEC is also affected due to long-term factors which are dynamic in nature. So let's understand these long-term factors. The very first one is population growth. In an overpopulated country, a rise in population shows widespread poverty. Thus, this has an adverse effect on the MEC. Therefore, if we need to increase investment in an overpopulated country like India, population control becomes necessary. The next long-run factor is technological advancement. Today, due to the growth of scientific inventions and technological change, new products, new methods of production, all this may be developed, which may have a favorable impact on the MEC in the long run. The last long-term factor is creation of an infrastructure. So if the country is engaged in the development of industries, transport facilities, and various types of public utilities, then in the long run, this will create a favorable impact on the MEC. So final conclusion, all the factors that we have understood here will lead to huge investment activities of all types in the economy. After understanding factors, we've also understood that investment decisions are not strongly influenced by interest rates. Rather, interest rates play only a minor role, very a small role in determining investment in different plant and equipment.